Welcome to The Explainer. You know, in the world of business, we're always taught that profit is everything, right? But what if I told you there's a better, smarter way to measure a company's real success?
When you look at a company, how do you really know if it's a winner? It's so easy to just look at the bottom line, see that big profit number and think, wow, they're crushing it. But that's only telling you half the story.
Because the real magic isn't just about making money. It's about how efficiently a company makes that money. It's about getting the most bang for your buck.
So, what do we actually mean by business efficiency? Well, think of it this way. Are you using the resources you have, your money, your buildings, your equipment, in the absolute best way possible to generate a profit? To figure that out, we can't just look at profit in a vacuum. Nope. We need a specific tool, a metric that directly connects a company's earnings to all the stuff it had to use to create those earnings in the first place.
And that brilliant little tool is called Return on Assets, or ROA for short. This is one of the simplest and honestly one of the most powerful ways to measure that bang for the buck efficiency we're talking about.
In simple terms, ROA gives you a clear percentage that shows how good a company is at turning all its assets, all the stuff it owns, into actual profit. A higher ROA just means the company is a leaner, meaner, more productive machine. And the best part? It's surprisingly easy to calculate. You just need two numbers from a company's financial statements. First, you find its net income on the income statement. Second, you find its total assets on the balance sheet. Then, you just do some simple division. And here it is, the formula in all its glory. You take the net income, you divide it by the company's total assets, and boom, you get your ROA. Simple as that. This one number tells you exactly how much profit the company generates from every single dollar of its assets. To make this crystal clear, let's imagine two hot dog stands. We have Sam, who keeps it simple with a $1,500 cart. And then we have Milan, who goes all out with a fancy $15,000 themed stand complete with a costume. Now, here's where it gets really interesting. At first glance, Milan made way more money, $1,200 in profit compared to Sam's $150. But look at the ROA. Sam's is 10%, while Milan's is only 8%. This means Sam's much smaller investment was actually more efficient at generating profit. Sam's getting a better return on his assets. And that simple analogy, it plays out in the real world all the time. To see how, let's look at a showdown between some major players in the retail sector.
Okay, here we have three names you'll know: Macy's, Kohl's, and Dillard's. You can see their net income and total assets right here. Now, Macy's and Dillard's have pretty similar profits, but look at the massive difference in their total assets. Macy's has over $16 billion in assets, while Dillard's has just $3.5 billion.
And that huge difference in assets is what makes the ROA so revealing. Just look at this. Dillard's ROA is an incredible 16.8%, completely dwarfing Macy's 3.5% and Kohl's tiny 0.8%. It shows, clear as day, that Dillard's management is doing a much, much better job of using its resources to make a profit.
Let's just focus on that winning number for a second. 16.8%. What this means is that for every single dollar that Dillard's invested in assets, its stores, its inventory, everything, it generated almost 17 cents of net income. That is the sign of incredibly effective management.
But like any powerful tool, you have to know how to use it correctly. ROA is fantastic, but it's a tool for analysis, not some unbreakable rule. So let's look at a few important nuances. You'll often hear ROA mentioned with another metric, return on equity, or ROE. The key difference between them comes down to one crucial word: debt. ROA looks at all assets, including those funded by borrowing. ROE, on the other hand, only looks at the return on the shareholder's investment, and it ignores debt. This means a company could borrow a ton of money to boost its ROE, while the ROA gives you a much more honest picture of its overall efficiency. And you really have to remember these limitations. The single most important rule is to only compare ROA for companies in the same industry. A software firm's assets are totally different from a car maker's, so a direct comparison is just meaningless. It's also a metric that's often best for asset-heavy businesses like banks. And finally, remember that ROA is just one piece of the puzzle.
You never make an investment decision based on a single metric.
All right, so now that you understand what ROA is and its nuances, let's talk about how you can actually put it to work for yourself.
As a general rule of thumb, an ROA over 5% is considered pretty good, and anything over 20% is fantastic. But again, this is just a starting point. The real value comes from comparing a company to its direct competitors, just like we did with the retail store. And finally, don't just look at a single number in a single year. Look for the trend. Is a company's ROA rising over time? That's a great sign that management is getting better and better. Is it falling? That could be a warning sign that the company is making poor investments that just aren't paying off. So now you have a new lens for viewing any company. You have a tool that cuts through the noise of those headline profit numbers to reveal the real engine of efficiency humming or maybe sputtering underneath. The only question is, which companies will you look at differently now?